There's a tax deduction sitting inside almost every investment property in Australia, and most owners never claim it. It's completely legal. It's been written into tax law for decades, and depending on your property, it can be worth somewhere between $5,000 and $15,000 a year. The wild part? You don't have to spend a single extra dollar to get it. By the end of this video, you'll know exactly what it is, whether your property qualifies, and how much it could be worth to you. Let's get into it. Depreciation just means something losing value as it ages. Think about a tradies ute. The moment it leaves the dealership, it's worth less than what was paid for it. The tools in the back follow the same pattern. Drill bits go blunt, blades dull, batteries hold less charge every year. Your investment property is no different. The roof ages, paint fades, carpet flattens under foot traffic. Hot water systems wear down. Every part of that building is losing value. Every single year, whether you notice it or not. The ATO has built this reality into the tax system. Because the building and its contents are genuinely losing value, the ATO lets you claim that loss as a tax deduction. And here's the part that surprises most people. You're not paying for anything new to get it. The wear and tear is already happening. The deduction is just the ATO acknowledging it on paper. The ATO splits this into two buckets, and understanding the difference matters. Division 43, Capital Works. This covers the structure itself, the foundation, brick walls, the roof, windows, doors, built-in wardrobes, anything fixed and structural. You can claim 2.5% of what it originally cost to construct every year for 40 years. So if a building cost $350,000 to put up, that's $8,750 a year, claimable for 4 decades. The catch is the build date. Residential properties need to have been constructed after the 15th of September 1987 to qualify for this category. Built before that, Capital Works depreciation isn't available, full stop. Division 40, Plant and Equipment. This is everything removable. Blinds, carpet, dishwashers, air conditioning units, ceiling fans, hot water systems. Each item has its own effective life set by the ATO, so they depreciate at different speeds. A carpet wears out and depreciates much faster than, say, a hot water system built to last 15 years. Now, here's a rule that trips a lot of investors up. Since the 1st of July 2017, if you buy a second-hand residential property, you can only claim Division 40 depreciation on plant and equipment that's brand new or that you've personally installed. Whatever the previous owner already had in the property, their existing oven, their existing blinds, none of that depreciation carries over to you. Replace it yourself though, and the new item is fully claimable from day one. A tax depreciation schedule is a report that maps out exactly how much you can claim, item by item, year by year, for up to 40 years. It's prepared by a quantity surveyor, a qualified professional who physically inspects the property, measures and photographs everything, and calculates the construction cost and the value of every claimable asset inside it. You hand that report to your accountant once. They use it every tax return after that. It's a one-time job that keeps paying out for decades. And the fee for getting the schedule done is itself fully tax deductible. So the cost partially pays for itself in year one. Say you bought a property in 2021 for $480,000. It was built in 2012 for a construction cost of $290,000. Since buying, you've installed a new dishwasher and a new split system air conditioner. A depreciation schedule on this property might show Division 43, $290,000 times 2.5% equals $7,250 per year. Division 40, on just the new items you installed, roughly $1,800 per year for the first few years. That's around $9,000 in total deductions a year. At a 32.5% marginal tax rate, that's close to $2,900 less tax every single year. Stretch that over a decade, and it adds up to nearly $29,000 in tax saved, from one report that typically costs a few $100s to prepare. Industry estimates suggest a large share of Australian property investors either aren't claiming depreciation at all, or are significantly underclaiming it. The reasons tend to repeat. People don't know schedules exist. They assume their property is too old to bother. They assume the 2017 changes made the whole thing pointless. Or they're doing their own tax return and the deduction simply gets missed. Each of those assumptions costs money. Older properties can still carry meaningful Division 43 deductions if there's been any renovation work since 1987. And the 2017 change only affected Division 40. Capital works claims were never touched. If you've been following the 2026 federal budget, you might be wondering whether any of this changes. The depreciation rules themselves haven't moved. Division 43 and Division 40 work exactly as before. But the broader tax settings around property have shifted, and that actually makes depreciation more valuable, not less. From 1st July 2027, negative gearing on established residential properties will be limited to those purchased before 7:30 p.m. on the 12th of May 2026. Those properties are grandfathered and keep full access to current rules. Properties bought after that date can still claim losses, but only against rental or property-related income, not against wages. New build investment properties are treated differently. They keep both negative gearing and the existing capital gains tax settings. And when sold, investors in new builds get to choose between the current 50% CGT discount or the new inflation-indexed method, whichever works out better for them. What that means practically, if your property is grandfathered, every legitimate deduction you can claim, including depreciation, is now protecting access to tax treatment that newer investors won't have. And if you're looking at a new build, a depreciation schedule becomes even more important, since new builds generally carry the highest Division 43 claims available. If any of these apply to you, it's worth getting a quote. You own an investment property and have never had a schedule done. The property was built after September 1987. You've renovated at any point. You've installed new appliances or fixtures since purchase, or you bought within the last several years and simply never looked into it. One more thing worth knowing. If you've been lodging returns without a schedule, you can typically amend up to the past 2 tax returns once you get one done. That can mean a real refund landing in your account for deductions you are always entitled to, but never claimed. A depreciation schedule is one of the few things in personal finance that sounds too good to be true, and genuinely isn't. It's not a loophole. It's the tax system recognizing wear and tear that's happening to your property, regardless of what you do. Get the schedule done once, and it keeps paying out for up to 40 years. If you own an investment property and don't have one, that's worth sorting this week rather than letting it sit on the to-do list for another year. By the way, if you're enjoying this video and you made it this far, comment the word schedule down below so I know who you are. Hit the subscribe button. Thank you for watching. I'll see you in the next video.